Thank you everyone for joining us tonight to go over tax tips for the 2022 tax season. This session will be recorded, so if you need to leave early, you can also find this later. We will be posting this on our YouTube account. And my name is Kelly Lai. I'm a staff attorney here at Brooklyn Legal Services Corp.'s Consumer and Economic Advocacy Program. I'm here with my colleagues, James, Naumann, and Stacey Kim, who will be going over the tax tips for tonight. Just an introduction. So Brooklyn Legal Services Corp.A, also known as Brooklyn A or BKA, we represent low and moderate income individuals and families throughout New York City. Even though our name has Brooklyn in it, we represent throughout New York City. And for over half a century, Brooklyn A has provided high quality, low barrier neighborhood-based legal services to the New York City community. We have 3 core programs at Brooklyn A. And at my program, the Consumer and Economic Advocacy Program, we prevent foreclosures and defend against predatory lending. We also represent individuals in bankruptcy court for Chapter 7 and Chapter 13. And for our low-income taxpayer clinic, we help resolve tax issues such as tax debt, innocent spouse relief, recovering unpaid refunds or stimulus checks for those mostly in the low-income taxpayer bracket. We also have 2 other programs. Our Preserving Affordable Housing Unit. We represent tenants facing evictions or their landlords violating fair housing law. And last but not least, Community Economic Development Program. We provide legal counsel to nonprofits and small businesses in the city. We also help negotiate rent and arrears. So tonight we'll be going over the tax filing requirements, some of the tax documents you might want to start gathering to prepare for your 2022 tax return. We'll go over the refundable credits, the self-employment obligations, how to obtain your ITIN if you aren't able to get a social security number, filing status, and dependents. So filing requirements. So this year, the deadline for 2022 is April 18th. And if you cannot file on time, make sure you file an extension with both the IRS and New York State. I will be focusing on New York State since we are in New York. This will extend the deadline to October 16th. Remember, even though this extends the time you can file, you still have to pay any tax debts that you may owe before April 18th. It does not extend your payment. So make sure you make that payment on time so you don't have interest or penalties that accrue. And with New York, make sure you utilize the New York State free file programs. So these are the 3 different applications that New York State has partnered up with. You do have to go directly from this website listed here. If you go from the company applications website, you'll likely end up having to pay for the state return to be filed electronically. So generally, if you make below $60,000, you should be able to file the federal and New York State for free. The income is adjusted upwards if you're also an active duty military. And for those who are US citizens, even if you lived abroad, you still have a filing requirement if you have made an income. The US is one of the few countries that it taxes income worldwide. Even if you do not live in the US, but you made income somewhere else outside of the country, you still have to file. And for those who are US residents who are not US citizens and you meet the substantial presence test, you also have to file a tax return. And this requirement is similar to the US citizens. Generally, the forms are very similar. For the substantial presence test, it is very specific. You have to be physically present in the US for 31 days in the current calendar year and 183 days during the 3-year preceding that. It sounds very complicated. To simplify it, if you have been in the US, you haven't left, you've been here for 3 years, you qualify for the substantial presence test. For some of you may be wondering, how much do I need to make so that it triggers a filing requirement? So like a lot of other tax questions that we hear, it always depends. It depends on your filing status, how much you make, and if you're under or over the age of 65. So for example, if you look at this chart for 2022 specifically, if you are married filing jointly with a partner, and you're both under the age of 65, and the combined income is more than $25,900, then yes, you have a filing requirement. And you can look at this chart. We will go over the filing statuses later to help you determine what bracket you fall under. Just a caveat, for those who are self-employed or have a business, and this typically applies to someone who earns cash, or an Uber driver, taxi driver, if you make $400 or more, you do have a filing requirement. And this threshold is very low. So even if you make $401 in 2022, unfortunately, you do have a filing requirement and you should file your tax return regardless of your filing status. There are free services in the city partnered up with the IRS called the Volunteer Income Tax Assistance Site, short for VITA. They prepare your tax returns for free. Generally, the requirements are those who make $60,000 or less, people with disabilities, or people with limited English speaking skills. And you can look at this website linked here. You can look up any ones in the city. Some of them also offer remote services. So if you sign documents electronically, send over to them electronically, they can file your tax return for you. So next I'll go over some of the tax documents you will need when you want to file your tax return. And these are some of the general forms that we do see. So for example, if you are an employee and you receive a income from a company and you're not self-employed, you should be receiving a W-2. You should have received this by now, and if you have not, contact your employer. They should have had that prepared already. If you are self-employed, then you may have received a 1099 NEC. You'll see this more if you're a cash earner, or you receive a 1099K. Some of you may be wondering if the threshold for reporting for 1099K has been lowered. This actually has been pushed out to next year. So as of right now, the threshold amount for reporting on a 1099K is still $20,000 and 200 transactions or more. And this may change next year, but as of right now, the IRS has delayed it because of the reporting complications and COVID. So well, right now the 1099K is still the same as before. If you are unemployed, you may have received a 1099G from the New York State Department of Labor. And even though this isn't technically earned income, you still have to report that on your tax return. Any and all income that you're not sure of, make sure you bring all the documents. If this seems too overwhelming, if you're unsure, bring everything to the tax preparer. More is always better than less. And some other common forms that we see for college or graduate students are the 1098T tuition statement and the 1098E student loan interest statement. This you can also get from the college directly, and they should have already provided a statement. For homeowners, you should have received a 1098 mortgage statement or any real estate interest that may have been generated. And then another common form we do see is for retirees, the SSA 1099 or 1099R. A lot of retirees may feel that because they have retired, they don't need to report this on their tax return, but it really depends on what your combined income is. So even if you receive a small amount, if this combined Social Security along with, let's say, a stock that you sold or an equity, or you took out a distribution, if it is a large amount, it may trigger a filing requirement. So if you're unsure, again, bring everything. And to just make sure that you have everything with you and that you don't accidentally miss a tax balance and have the interest and penalties accrue. And one last thing I wanted to go over is the IRS transcripts. So when you electronically file your tax return, the IRS will ask for a prior year adjusted gross income amount. And tax document is, for some reason you've lost it or don't remember where you placed it, you can always go onto the IRS website listed here and pull up a 2021 return and look at the adjusted gross income that you have filed. You will need to have a valid email, phone number, photo ID. They will also ask for a face scan so that you can set up this multi-factor authentication to retrieve your prior year adjusted gross income. This is applicable going forward. The IRS is trying to make everything more secure. That's why they're asking for so many of your personal information. And next, I'll pass it on to James to talk about refundable credits.
So I'll begin with, I will be talking about refundable credits, two refundable credits, and then also going into self-employment issues. But before speaking about refundable credits, I just want to break down the difference between a credit and a deduction. A deduction is something that you can claim on your return that reduces the gross income amount, so that it reduces the gross income amount to the adjusted gross income. And this potentially lowers the taxpayer's taxable income. So based on how much you are earning, the government will assess a certain percentage of tax. And so by reducing that through deduction, then you may possibly have a lower amount of tax due. A credit, on the other hand, is a qualifying amount that the government applies to the tax that's finally owed. And then if the tax that's owed is brought down to zero, then the government gives you the remainder of that credit back. So it ends up being cash in the pocket. A credit, for this reason, is always better than a deduction because the taxpayer is getting cash at the end of the day if they qualify below the zero amount. I just want to point out the qualifying term here. Of course, the government is setting these standards for which not everyone does get this credit or a credit. So you do have to meet certain requirements. So let's go through those. First, I'll be talking about the Earned Income Tax Credit, also known as the Earned Income Credit. So you may see EITC or just EIC. This is a tax credit for certain qualifying taxpayers who work less or who work, period, and then earn less than $59,187. That's a cap. So we'll be talking a little bit about the various amounts taxpayers have to earn. The cap at $59,000 plus is for married filing jointly. It's less if you're single. So this credit is based on earnings and not expenditures. I want to break down the difference between those two things. So earnings, that's obviously money that you, the taxpayer, are taking in because you earn it as income, versus expenditures, that's money that you are spending, so it's going out of your account. So most often, the government will give credits based off of expenditures. A good example of that is the Affordable Care Act, the ACA, also known commonly as Obamacare. You may remember when that was passed, there was a lot of discussion about whether or not that was a tax and what would happen. So the government said to incentivize people to sign up for health insurance through the government's marketplace. Of course, they would have to pay for that, but then the government said, listen, if you're paying for health insurance here, we will give you, after you spend that amount, we will give you a credit back, so you'll get cash back. You'll be credited that amount you spent. So the EITC is different though, because you don't have to spend any money for it. You just have to make some money. And then if you do make money, then you may qualify for this. So what is earned income actually? Earned income is all income that one makes from employment. This includes wages, salaries, tips, bonuses. It also includes net earnings from self-employment. So if you're self-employed, obviously you're covering all expenses, all overhead, and then you can deduct those expenses, and then you are brought to the net earnings, so the smaller amount. And then also military members also can qualify for the EITC. If they are deployed to a combat zone, the government will compensate them for that time, and they can also elect that to be earned income. What is not earned income for the ITC, anything that you make by way of pension or annuities, if you are taking any welfare benefits, if you're making unemployment from the government, workers' compensation benefits, social security benefits, these do not count as earned income. So if all of your earnings for the year are just unemployment or just welfare, unfortunately, you would not qualify for the ITC. So just a little bit about history or for some context here. The EITC actually was introduced in 1975, so it's quite an old, established, and well-respected and well-loved bipartisan credit here that's offered through the IRS. It's been expanded several times. It was initially designed as a labor program. So the incentive was if you are out in the workforce and you're making money, but not enough money to live and support yourself, the government would give you more money to sort of boost you, hopefully out or maybe into a better income bracket. Because of all the expansions over the years and decades, it's developed into a pretty robust anti-poverty program. So again, the more money you're making, the more money you'll be getting back from the government, and the larger your household is, the more money you could be getting back in the ITC as well. Currently, this is the largest federal means tested cash transfer program. What that means basically is this is the largest program that the government is giving cash back for. So this just means that because the government's spending so much money, there's a lot of red tape around it. And it tends to therefore trigger a lot of audits for low-income earners, which is just an unfortunate reality. So that many of our clients actually have been audited. But I say that not to frighten you, but more to encourage you that we are here to help. So if you've ever been audited by the IRS, don't be afraid to, as you go through your free tax forms, if you qualify for that, as Kelly mentioned earlier, these programs will help guide you through and automatically claim the EITC for you if you qualify. And of course, if you are audited, we are here to help you through that system. So there are 7 requirements, more or less, to be qualifying for the EITC. Your adjusted gross income must be less than $53,057 if you're single, filing single, or $59,187 if you're married, filing jointly. You must have a valid Social Security number by the due date of the 2022 return. So the due date, again, is April 18th. You must meet certain requirements if you're separated from your spouse and not filing a joint return. Stacey's going to be going over in a little bit what some of those terms mean. How will you file single, married filing jointly, married filing separately. You must be a US citizen or a resident alien for the entire tax year of 2022. You cannot file Form 2555. This just relates to income that you may earn in another country. Investment amounts, if you have any of those, they cannot be above $10,300 or else you would not qualify for this. And then obviously then you have to earn income. So again, this ties back to the idea that it was initially like a labor incentivizer. So the government saying, please go out and seek work. And then if your job is not paying you enough, then the government will help you, hopefully boost you into a better bracket. A few more things, just some age qualifications here. If you do not have qualifying children in 2022, you must be at least age 25 to claim the EITC, or under age 65 by the end of 2022. And also a note here, if you do have individuals and couples who do have a Social Security number, they can claim the credit, but if their children don't have Social Security numbers, those parents and individuals can still claim that. It just would move you into a different level of how much you'd be bringing in. Next slide, please. So here's just a chart to show you just the different maximum levels that you must make, and depending on how many children you have, so you can sort of see how this works. If you are filing single, head of household, or widowed, and you have no children, the maximum that you earn is $16,480. And you can see already that once you have children, 1, 2, or 3 children, the government only acknowledges up to 3 children for this credit. You are allowed a much higher level of income. So again, this underscores, even though you are single, you're still able to, single maybe without children, you may still get the EITC, but its biggest impact is really for those families out there. Again, like an anti-poverty program. So with this yellow arrow, just to underscore that point, the maximum credit you could possibly get without children is $560, whereas just with 1 qualifying child, you already can make up to $3,733. And then, of course, it goes up to almost $7,000 if you have 3 qualifying children. So again, quite a lot of money that the government is willing to support for low-income earners, low-income families. So here's just a quick slide on the possible effects on welfare benefits. The good news is there are none. No refund amount that you may get from the EITC will be counted toward income for eligibility if you are also claiming temporary assistance for needy families, known as TANF, or Medicaid, or Social Security, SNAP or food stamps, or low-income housing. So if you have to report your income for these things, but if you are getting as much as perhaps even $7,000 from the EITC, none of that can be included in your income for welfare benefits. So it does not factor against you in that way, which is a good thing. So on to the second tax credit I want to talk about, the child tax credit. It started in the 1990s. It's more or less stemmed out of the EITC. Again, it's an additional governmental form of broad family relief. It's similar to the EITC in certain ways and also different from it. It is refundable. So that means that if it brings your taxable amount down to $0, then you will receive an amount back as cash from the government. It does, the amount you could get does increase with the number of children you may have. It benefits a taxpayer at the lowest level of income, but it's also earnings based. So one needs to make some kind of earning in order to claim this credit. It's different from the ITC in that it also the child tax credit also benefits middle income families. It starts to taper out once you may reach $400,000 if you're married and filing jointly, or if you're a single filer at $200,000. So it's, again, giving cash just for, I guess, like larger family support, but this extends well into the middle class. Taxpayers receive the same maximum credit for each qualifying child. And also the ages are slightly different here between the EITC and the child tax credit. So for the child tax credit, a qualifying child must be age 17 at the end of the tax year. Whereas for the EITC, they could still claim them up to age 19, or if they're a full-time student, up to age 24. But sometimes those age differences can be a bit confusing. With the child tax credit, the taxpayer must earn a minimum of $2,500. This was not the same for the EITC. So as soon as you're making some earned income, even if it's a small amount, you can already qualify for a credit. With the child tax credit, in order to get this credit, you have to have at least a minimum of $2,500 of earned income, rather. The amount is up to $2,000 per qualifying child, partially refundable. That partially refundable makes it different from the EITC, meaning that once the tax amount, the tax owed to the government is brought down to zero, for the EITC, you would get the full balance back. For the child tax credit, it starts to, the government only factors in a certain percentage, so you don't get like the full amount back if you're brought down to zero. Also, I want to make note that the American Rescue Plan, there's been lots of COVID aid, which has been a great thing. They did boost that up, so you may have seen very large or larger amounts in previous years. I think it's like $3,000 for infants up to age 6, maybe, and then from 6 to 17, perhaps $3,600, or maybe it's the other way around. That was a one-time only deal, basically, so that's no longer in effect for tax year 2022, just to make you aware of that change. You must have a taxpayer identification number by the due date, and that does include the extensions. And then each qualifying child under the age of 17, or rather it's just a point to bring back to the 17 age limit. So then I want to talk about two education credits briefly, the American Opportunity Credit and the Lifetime Learning Credit. There are three qualifications for both of these credits. You, the dependent, or a third party who pays qualified education expenses for higher ed, you must be one of those three. The eligible student must be enrolled at an eligible institution. Most institutions probably are eligible. If you're not sure, there's a database here that's listed that you can check. Also, if you're receiving a T1098, automatically it's an eligible institution. And you may not receive that in paper copy. You might also have to go to like your educational institution's webpage to receive that digitally. But if you are receiving that, you know it's automatically an eligible institution. And then the eligible student is yourself, a spouse, or dependent listed on the tax return. So when you cannot claim an education credit, when someone else, such as a parent, lists you as a dependent on your tax return, you may not claim it. When your filing status is married filing separately, you may not claim these education credits. If you already claimed or deducted another higher education benefit using the same student or same expenses, you can't also claim these. If you were a non-resident alien for any part of the year, and you did not choose to be treated as a resident alien for the tax purposes, you can't claim these education credits. And then again, finally, as long as you're receiving a 1098T from an academic institution, you should be qualifying for these then. So the AOTC, the American Opportunity Tax Credit, this is a credit for qualified education expenses that are paid for an eligible student. Students must be seeking a degree within the first 4 years of higher education. So again, this is really going toward an associate's degree or an undergraduate degree. So if you're already pursuing maybe even your first degree beyond 4 years, you've claimed this for 4 prior years, you would not qualify. Or if you're in graduate school, this is not the credit for you. The next one would be. The maximum credit is $2,500 per eligible student. And like the previous credits, the credit does reduce the tax amount owed. So if after you file your taxes, you enter your income, and if you do have a taxable amount to the federal government, this will reduce it down to zero. If it does get down to zero, unlike the previous credits, only 40% of the remaining credit will be refunded to you. So it's not like, for instance, if your tax bill is $500 and you're brought down to zero, you would not see $2,000 returned to you. You'll only be getting 40% of that $2,000. And if you have more than 2 students that qualify for this, you'll be seeing 100% of the first $2,000 for the first student, for student A, but then only 25% of that $2,000 for student B. So it does not get refunded to you in the exact same ways for each qualifying student. So some requirements for the AOTC. You must be pursuing a degree or other recognized education credential. You can't just be taking continued education courses without a degree goal. You must be enrolled at least half-time for 1 academic period beginning of the tax year. So again, this last tax year, 2022, if you were enrolled maybe in the spring semester of the 2021-2022 academic year, or just maybe the fall semester of this past year, 2022 to 2023, even a quarter, I mean, some academics institutions go by different systems, so at least half-time for one of those qualifying periods. As I mentioned before, you cannot have finished the first 4 years of higher education. This only is really for starting students, post-GED or high school students. You cannot have claimed the AOTC or the former HOPE credit more than 4 tax years previously. You cannot have a drug felony conviction for the end of the tax year. And there's also a tax form 8863 to attach with the tax return if you're filing for this. That applies for both this and the lifetime learning credit. There are, as with all credits, all these credits, just some limits. I think if you start to reach the 80,000 single or 160 jointly, After that, it starts to taper off. And then if you go beyond $90,000 of income, it's no longer available to you. So again, it's more geared toward certainly lower income and some middle income too. The lifetime learning credit, this is for qualified tuition and related expenses that are already paid. This is for eligible students enrolled in all eligible higher education institutions, like the previous one. And unlike the AOTC, this does extend to degrees beyond 4 years. So as long as you're in graduate school, professional school, even just taking any single class to acquire a new skill or maybe to improve job skills, if you start a new job and you want to get some new skills, you could potentially qualify for the lifetime learning credit. And also, unlike the AOTC, there's no limit on the number of years you can claim. So you can continue to be a graduate student and claiming this, or continuing to seek improve job skills through classes, and perhaps always be eligible for this. It's worth up to $2,000 in tax return, but unlike the previous credit, it is not refundable. So this will reduce your taxable amount, but you won't see any remainder in your pocket, basically. So a bit about self-employment, just to go over a few important things here. There are some obligations here. If you're self-employed, you do have to pay tax on that money. There are two taxes. There's a self-employment tax, which is for Social Security and for Medicare. And there's also the income tax on that. Why is this? So what happens is that employers, if you're employed with an organization or a corporation or whatever, employers are already pulling out the self-employment or the SE and the income tax. But if you're self-employed, you're seeing all the earnings in full. And so the government's just asking you to pull out those taxes as your employer would for you. So you are both the employer and the employee. You just have to do it yourself and then report those. And as Kelly noted before, as long as you're making more than $400 or more, you are required to report this as self-employment tax. A few things. There's a difference between business and hobby. So a business operates to make a profit, but people engage in hobbies for sport and recreation and not to make a profit. What's important is that both get reported on your tax return. A hobby just gets reported on Schedule 1. The difference is that if you have a hobby and you're making money, you may not deduct these expenses. If you have a business and you're making money, you can put any expenses that you're expending, that you're paying out on your tax reform as deductible expenses then. There's like 9 factors that the government will use that you also can use to determine whether the income you're making is for a business or just for a hobby. Things like, are you carrying on the activity in a business-like manner? Does the time or effort you put into the activities indicate that you intend to make it profitable over a long period of time? Do you depend on this income for your livelihood? Are any losses due to circumstances beyond your control, or are they in the normal phase of startup of a business? So again, if you can Google the IRS or go to the IRS webpage on businesses, they'll have the full list of 9 factors, but these will help you determine whether or not any money you might be making on, like, say, Etsy, just selling something is a hobby, or if it's a full-fledged business, that you should report that as a self-employment business income. So also we have a different classification between workers. There's some important things to go over here. Whether a worker is an independent contractor or an employee, it depends on the relationship between the worker and the business itself. So the relationship with the parties is important because it depends on whether or not you have a written contract or employee benefits. Both have different types of behavioral control issues. So there's difference between how the employer will be able to control the employee versus how they will be able to just set the standard and let the independent contractor determine a lot of things that are within their control for any job. And then there's difference here between what each of those may take. An employee is going to take home a W-2 versus an independent contractor will take home a 1099 NEC. And I'll pass on to Stacey to talk about our next section.
Yeah, thank you, James. So I'm going to talk about obtaining an ITIN. What is an ITIN? It stands for an individual taxpayer identification number. So if you have a filing requirement, but you don't have a social security number and you're not eligible for a social security number, you can apply for an ITIN through a form called W-7. If you look on the screen, there's a screenshot of it. It's a short form, and I'm going to go over what you have to include with the form. But first, there's a few misconceptions about the ITIN that I want to clear up. First, the ITIN doesn't authorize you to work in the United States. It also doesn't entitle you to Social Security benefits, and it doesn't qualify a dependent for EITC. So if you qualify for an ITIN and you're trying to file your 2022 tax return, what you have to do is you have to file them together. So you can't file the Form W-7 independently. We recommend that you schedule an appointment with the Taxpayer Assistance Center called TAC, and bring your completed Form W-7 and your 2022 tax return, along with a supporting document that I'll get onto the next slide that establishes your foreign status and identity. So if we go into the next slide, these are some examples of supporting documents that the IRS will accept for your ITIN. We recommend that if you don't have a current passport, as in if your passport is expired or you lost certain identification documents, then you can contact your consulate and request an ID and birth certificate. And I also want to make sure that we emphasize that if any of your documents are not in English, you'll have to supply translated versions of those documents in English. Lastly, on the subject of ITIN, if you are applying for an ITIN this year, you should file your 2022 tax filing extension so that you have until October 16th of this year to file your 2022 tax return. I'm gonna now talk about filing statuses. You have to choose one of these 5 filing statuses in order to file your tax return. I'm going to focus on the last 4 here because if you don't qualify for any of the last 4, then you would file as single. So if we go on to the next slide, the first filing status I'm going to go over is the qualifying widow. When should you use the qualifying widow status? So if your spouse passed away in 2020 or 2021 and you didn't remarry before December 31st, 2022, then you can file as a qualifying widow. There are certain criteria that you have to meet, including you have to have a child or a stepchild, but not a foster child whom you can claim as a dependent. Additionally, that child has to have lived with you for the entirety of 2022, and you had to have paid more than half the cost of maintaining your home. If your spouse passed away in 2022, though, you can opt to file as married filed jointly, which is the next filing status I'll review. The married filed jointly requires that you and your spouse meets these requirements on December 31st, 2022. So you and your spouse had to have been married and living together, or you and your spouse had to have been living together under common law marriage, which is pursuant to different state laws, living apart but not legally separated, or separated under interlocutory, so a non-final decree of divorce. One thing to really keep in mind if you choose to file as married filed jointly is that both spouses will be jointly responsible for any tax debts and liabilities that arise out of that tax return. So even if one spouse made the majority or all of the income and you end up owing taxes for that income, both spouses will be responsible for that taxes owed. If you don't want to file jointly, but you are considered as married, you can choose to file as married filed separately. So one thing to keep in mind if you do file as married filed separately, and this will impact low-income taxpayers the most, is that you'll be disqualified from credits, including the Earned Income Tax Credit, the American Opportunity and Lifetime Learning Tax Credit, Adoption Expenses Credit, and the Child and Dependent Care Tax Credit. There are certain situations where you should consider married filed separately or where it could benefit you. And that's where if, say, one spouse has large student loans or medical expenses, usually for these deductions, they consider the amount of income. And under married filed jointly, your income would be combined. So in married filed separately, it might actually help you to report the lower income separately. Also, if one spouse has significant debt or tax liabilities, it could be useful to separate that so that your refunds won't be automatically disallowed and used to offset those debts. The other filing status, head of household, requires that you're unmarried or considered unmarried on December 31st, 2022. You also had to have paid more than half the cost of your home, and a qualifying person has to have lived with you in the home for more than 6 months in 2022, except for temporary absences, like if that qualifying person was going to school. The only exception to the last point where the qualifying person has to have lived with you in the home is if that qualifying person is your dependent parent. If they're your dependent parent, then they don't have to have lived with you for more than 6 months of 2022. The conditions for being considered unmarried is you had to have filed a separate return, paid more than half the cost of your home, and your spouse lived separately from you during the last 6 months of 2022. There are certain special circumstances where even if physically the spouse wasn't with you for the last 6 months of 2022, they're still considered as living with you, such as military service. So keep that in mind. Additionally, your home had to have been the main primary residence of your child, stepchild, or foster child for more than 6 months of 2022. And you must be able to claim that child as your dependent, which I'll go over in a few slides. One tip is to keep records of your lease or residency letters so that you can show that you and your spouse were living separately during the last 6 months and that your child that you're claiming as a dependent was also living with you. So there are 2 categories of dependents. The first one is a qualifying child, which is quite a broad category. They have to be related to you, either your son, daughter, or sibling, or descendant of any of them. They also had to have lived with you for more than half of 2022, and they must not have provided for more than half of their own support financially. They also must not be filing a joint return unless that joint return is filed to claim a refund of withheld income. There's also age requirements for the qualifying child. So they have to be younger than 19 years old by the last date of the 2022 tax year and younger than you. They have to be younger than 24 if they're a student. And they can be any age if they're permanently and totally disabled. And just to repeat, a tip is to keep records of your children's residency. That can look like doctor's letters, school enrollment letters, just in case the IRS or New York State audits you and requests verification that your dependent was living with you. Sometimes you might encounter a conflict where two people are trying to claim the same child. And if that's the case, the IRS will go through what's called tiebreaker rules. And this is kind of a hierarchy of how they prioritize who gets to claim the qualifying child. If a parent is involved, if a parent's involved and a non-parent's involved, then the parent will get to claim the child. However, if both people are both parents, then whoever the child lived with the longest will be able to claim the child. Let's say the child lived with both parents equally, then it's the parent with the higher adjusted gross income who will get to claim the child. If a parent can claim and they don't, then the person with the highest adjusted gross income will break the tie, but only if it's higher than the adjusted gross income of the parent. And lastly, if no parent can claim the child, then it's the person with the highest adjusted gross income that can claim that child. Next slide. The other category of dependents is called a qualifying relative, and the qualifying relative can't be your qualifying child or the qualifying child of any other taxpayer. They have to either be related to you or have lived with you for all of 2022 as a member of your household. The person's gross income for the year must be less than $4,300, and you must have provided more than half of the person's total support for the year. Okay, and then some miscellaneous tax tips I'm going to go over. First is innocent spouse relief. So as I mentioned before, if you're filing married filed jointly, then both parties will be liable for any tax debts. The IRS, they allow for innocent spouse relief if you filed a joint return and then there was an error on that joint return that you didn't know about, and as a result, you're liable for paying additional taxes. The requirement is that you didn't know about the error and it's not related to your own income, household employment taxes, individual shared responsibility payments, business taxes, or trust fund recovery penalties. Basically, if a reasonable person wouldn't have known about that understated tax or incorrect deduction, any kind of error, then you can request for innocent spouse relief. One exception to the knowledge of error is if you are a victim of domestic abuse and if you were coerced into filing a married filed jointly return or any scenario involving domestic abuse, then you can file Form 8857, which is the general request for innocent spouse relief, and see if you qualify for that relief. Lastly, if you're experiencing a tax-related scam, let's say someone used your social security number, or you can't claim a child for some reason that you're unaware of, then you might be a victim of identity theft or some other kind of scam. And in which case, there's a couple ways to address it. One is by filing a Form 14039. All these forms, by the way, you can find online. And it's called the Identity Theft Affidavit, where you state the situation, how it's affecting you. Form 911 is the request for taxpayer advocate service assistance. This is helpful if you haven't been able to resolve your tax issue within a reasonable time frame, and you've exhausted all other resources for resolving your tax issue. You can also get an identity protection PIN and apply for it online. This is to help people who have been victims of identity theft, and it just adds an extra layer of confidentiality and confidence in filing your tax return. Finally, the tip that I want to give you is that the IRS will never initiate contact with you via email, text message, or social media. So be wary of any scams. If it feels suspicious to you, you can report it. You can also contact our office if you think you are a victim of a tax-related scam.
Well, that concludes the end of our presentation, and thank you so much for everyone who has joined us. I know we have a few questions listed, but for those, if you don't feel comfortable sharing it in this public forum, please give us a call at 718-487-2300. You can also email us at info@bka.org. So one of the first questions is, I'm unemployed, but I received a stimulus last year. Do I have to file for my taxes this year? And you don't have to answer this in this public forum, but I'm assuming when you say stimulus last year, you mean you received unemployment from the New York State Department of Labor. So if that is the only income you received and no taxes were withheld, unfortunately, you still probably have a filing requirement. And if there were some taxes withheld, there may be some refunds that may be available to you if it was withheld correctly, or even more than the necessary amount. But it will depend on your filing status again, and if that is the only income you received. And another question, is the stimulus considered income? Do we have to file this year, especially if you were unemployed for the whole year of 2022? And do we get the earned income tax credit from the federal or the state? So the stimulus, I'm not sure if you mean the stimulus checks, the economic impact payments that the IRS was giving out, or the child tax credits that were being given. If you're talking about those two specifically, then that is not considered income. It only will be considered income if there was a delay from the government in issuing those payments out. So let's say you were supposed to get $3,000 from the child tax credit and the economic impact payment, also commonly known as the stimulus check, but the government was slow at giving that to you. There was a $10 extra interest that they added on. That $10 is reportable if you received it in 2022. You do have to report it on your tax return. If you were unemployed for the entire year, unfortunately, as James said, you do need to have some sort of earned income. If you received absolutely no earned income, you don't get any earned income tax credit from the federal or New York State. And if you have additional questions, then feel free to type it in the Q&A. So the next one is similar. People who are unemployed, do they get earned income tax credit? James, do you want to take that?
Sure. So if you are unemployed, perhaps not, you may not be. If you are on unemployment, so if you're receiving unemployment benefits, again, as Kelly was saying, it may depend. This is the last tax year was 2022. Let's say you were employed at the beginning of the year, but then you went on unemployment halfway through the year. So you were making earned income for the first half of the year, and then you went on unemployment, and you may still be receiving unemployment benefits. In that case, you were making some earned income for that year. So you may qualify for the EITC, yes. If you were just, as Kelly was saying, if you're just on receiving unemployment benefits for the entire year, or that's all that you are receiving, then you would not qualify for the EITC. And that's regarding benefits. If you were simply unemployed and you were not making anything, also you would not qualify for the EITC, unfortunately. It's the way the program was designed. There's been a lot of talk, or there always sort of has been in Congress, should the program really be designed to bring everyone out of poverty, whether they're working or not? And there was sort of this consensus around, well, let's just make it about incentivizing work, those who are working and they're not making enough, so they can raise them to a higher level of income. So that's just an unfortunate reality of the way the EITC was designed. So far, that's what we have.
And the next question, do unemployed people get any kind of refund for federal or state? So it really depends on, did you receive any type of earned income? Did you have any other types of sources of income that you may have received? So if you don't feel comfortable sharing that publicly here, feel free to contact us at the number or email listed there. We're happy to go over your entire income history and to determine if you may be able to get a refund or not. Okay, another question. I'm on public assistance with 2 children. Can I still file for taxes and receive the EITC? So public assistance, unfortunately, does not count as earned income, but again, it depends on whether you made any other types of earned income from maybe cash from your employment, or if you have a W-2, the EITC, the name itself is Earned Income Tax Credit. And unfortunately, the way it is set up, you do need to have some employment-related income. But without knowing the full history, it's hard to tell if you will receive any type of refund. We'll have to dive in a little bit deeper. And can I get a copy of the presentation? Yes, so this presentation is recorded, so you will be able to see this later, but Jean, I will copy your email and I can forward you the presentation afterwards. So let me just copy that. Okay, and oops. The next question, since when has stimulus work credit been filed? After COVID? If before I never filed, check that credit. So the stimulus checks, sorry, let me just make sure I copy this email. The stimulus checks were issued out during COVID for tax year 2020 and 2021. There should have been 3 stimulus checks that were issued out. They are based on prior year filings though. So 2020 is supposedly based on 2019 or 2018 tax return. 2021 should be based on 2019 or 2020 tax return. So if you have been a non-filer for many years, there is a possibility that you did not receive the stimulus checks. You can check online on the IRS website for your account transcripts to see if they have been issued out. And if they have not been issued out, you can still file your tax return. So you have 3 years from the filing date to file your 2020 tax return. So let's see, 2021. So you have until next year of April to file your 2020 tax return, and then April of 2025 to file your 2021 if you did not receive your stimulus checks. If you did file those prior year tax returns and the government may have just lost the check in the mail, you can call the IRS and ask them to do a refund trace and see where that check has been lost, or maybe it was deposited, but the bank has closed or your account has been closed, and definitely give the IRS a call just to figure out where that refund or stimulus check has gone. So I think those are all the questions. Okay. I'll give it a few minutes just in case there are any remaining questions. I don't see, oh, there's another one. Homeowner may qualify separated. Please also email copy of the PowerPoint because my daughter, okay. Yeah, we can definitely email the PowerPoint slides. And if you have more detailed questions about your situation, definitely contact us and we're happy to answer then. Just give it another minute in case you have any remaining questions. All right, well, thank you so much, everyone. I don't see any remaining questions here. Again, this is recorded and will be on our YouTube channel later. And for those who requested the copies, we will be sending out the slides later to you. Well, thank you so much for joining us on a Thursday night, and I hope you have the rest of your day. And thank you, James and Stacy, again for joining.
Thanks, everyone. Good night.
Thanks for joining. Bye, everyone.
Bye.